All right, hi, good evening. Welcome to tonight's webinar, How to Become a Successful Stock Investor. I'm Tyler Ballhorn, founder of Stockscores, the author of the book that you see there on screen, which you can only buy at stockscores.com if you wish. It's not in stores anymore. All right, what's the itinerary for tonight? We're going to talk about the theory behind the Stockscores approach to investing, the things that I focus on. Talk a little bit about how long does it take to manage a portfolio, to manage your money using my approach. I'll show you around the Stockscores Education Center a little bit. And then the last point is we will talk about how to know when to get out of the market to avoid the sort of carnage that we've seen in the month of October. You can apply that to individual stocks as well. I'll just show you some simple ways to define exit points in a stock or in a market. All right, so let's jump right in. So the theory behind the Stockscores approach. Our aim, of course, is to find market-beating stocks, those stocks that move up faster than the market, or if we're trying to make money from a stock going down, of course, we can short sell stocks and make money that way. Either way, we want to find stocks that are beating the market. So if the market returns 8% in a year and we find a stock that earns 12% a year, then that particular stock has beat the market, and that's good. And of course, if we can find a stock that makes 100% in a year, well, that is even better. So I'll give you a little background, and I've told this story before, so if you've watched my webinars before, you'll have heard this story before, but just a little background on how I came to use this approach that I use. And I've been using it since I don't know, 25 years probably. And that was this. When I was in university in Calgary, I was in the business program focused on finance. In my final year of the finance program, we did a study. I was in a class where we looked at whether stocks moved on inside information, whether there was evidence in the market that people were trading on inside information. And we did an analysis of companies that had made really big news, market-moving news, in the form of a buyout or a merger. So the company was being bought. Typically, there was a premium paid for that stock. If you knew about that deal beforehand, you could buy the stock before the deal was announced. The deal gets announced, the stock jumps up to reflect the price that the buyer is willing to pay. You know, perhaps the stock was trading at $20 and the buyer is willing to pay $30. You get a big jump in price in a single day. And so if you had inside information about that deal, then you made a risk-free big profit, market-beating profit. And the assertion was always that there was people trading on inside information, but what we did in this class is try to prove it with math. And we did so by doing statistical analysis of the stocks trading in the weeks leading up to these big news announcements. And we found, almost without fail, that these stocks traded with some statistically significant trading activity that, because it occurred over and over again on these big announcements, it was not a fluke. It was clear that someone was trading on better information than others. And that's really the basis behind my approach even today. There's always going to be people that have better information, and my aim is to figure out what stocks they are buying. And I'll get into that a little bit more as we go along. But our primary goal is simply to find stocks that trade in upward trends or downward trends, most likely upward trends, and do better than most. And so you can see that this stock is a market-beating stock. This is a one-year chart, and last year in November it was at $26 a share. This month, before the pullback, it hit, sorry, I've got something covering up the numbers here, but it hit, you can see it, but I can't, 44, well, it topped out at around 47, almost $48 a share. That's market beating. And you can see that the climb in the shares has been fairly consistent, and it actually went somewhat parabolic, which we'll talk about in a little more detail as well. All right, so that's the kind of thing we want to find, those stocks that do that, not stocks that move in the same sort of ratio as what the market is doing. So now, why does it happen that stocks move in strong trends? Why do some stocks beat the market while most do not? Well, the reason comes down to fundamentals. It's the company's business that drives the performance of the stock. So if their earnings are growing, if they are a gold mining company and they discover a new deposit of gold, if they're an oil company and the pipelines to get oil out of Alberta to foreign markets is built, all of those things have a positive effect on earnings. And those are the sorts of things that make stocks move faster than the market, because those are things specific to the company. You know, the installation of a new pipeline doesn't really help most stocks. It helps oil stocks. The discovery of a new oil find helps that oil company. The change in price of oil helps that oil company. So there are things that are particular to individual stocks, and those are the things that make stocks move in strong trends. So it really comes down to the fundamentals. However, I want to make an important distinction, because throughout history we see stocks that move seemingly on a good story, but not necessarily with great fundamentals. And when I speak of fundamentals, I mean earnings growth, good balance sheet, that sort of thing. One stock that comes to mind is Tesla. Obviously a very charismatic leader of the company, Elon Musk. Great products, done some amazing things, but financially, you know, the company really hasn't done things that support its stock price. And so it's not enough to say that it is the company's fundamentals that drive stock price. It is really the perception of fundamentals. And perception is often clouded in human emotion. Elon Musk, because he's a neat character and he's done some amazing things, has the ability to put more value or add more value to a company simply because he is running it. And we shouldn't discount how perceptions are shaped by human emotion and that sort of thing. Your mood is largely going to drive what your perceptions are. And if the market is in an upward trend, you tend to be optimistic. If you like the products of a company, maybe you love Apple products, you're going to tend to be more optimistic about the company's fundamentals than if you were pessimistic about the company. So we should always make sure we recognize that the market has emotions that affect how fundamental value is judged. So when we see a stock moving in a strong market-beating trend, it's typically because there's some significant change in the fundamentals, or at least in the perception of fundamentals, that drives the stock's price. You know, in this period here for this company, obviously the market didn't think very much of it. And then one day, right there, some investors figured out that there was something exciting. Stock started to trade more volume. Price action was significant, and the stock went for quite a run from $8 a share to where it is now. Where it is now, you know, $17, $18 a share. So more than a double in just not even 6 months. All right. So we talk about fundamentals, and I indicated from my story about how I came to trade the way I do from my university days that really the stock market is not always fair. There are some people who get better information than others. Who are these people? Obviously, if you work for a company, you probably know more about that company than most. Certainly, if you're the executive of the company, maybe you're the chairman, the president, some of the vice presidents, you're going to know more about that company than most. But it goes beyond that. There are large investment funds, maybe an investment fund that manages $10 billion who, invested a large sum of money on a private placement, a fundraising by a company like Tesla. Chances are they have Elon Musk's phone number. They can maybe get better information than others. They're simply those people who do great research, who have insight into a company's business. Maybe they're experts in the biotech sector. Maybe they are experts in oil and gas. And through their specialization, their contacts in the industry, they maybe don't know with 100% certainty when something big fundamentally is going to happen, but because of their expertise and their contacts in an industry, they can certainly do better at predicting a stock's future performance than an average investor like you or I, because we don't have that expertise in most companies. Now, some of you listening to this webinar may be an expert in your field. Maybe you work for an oil company in Calgary and really know that business and know that certain companies are doing things better than others. That's always going to happen. But to know something about every stock in the market is difficult, if not impossible. However, there's always going to be someone that knows more about a particular company than anyone else. And when they act on that information in the market, they will leave a trail for us to follow. And so when I was doing that study in my university days of companies that traded on inside information before big news announcements, we found footprints. And the footprints look like this. Abnormal price action, abnormal volume. That doesn't show that abnormal, but relative to the past, it was abnormal. Doesn't show relative to the future that it was abnormal. And so we can start to use math to identify stocks that are trading abnormally as a clue that maybe someone is trading that stock with information that most people don't have. Now, as more and more people get the information, more and more people are motivated to buy, and that's what causes stocks to trend higher. It is the people that know the most that buy the stock earliest in the trend. It is the people that know the least that buy the stock late in the trend. This is the investing public, the average Joe or Joanne, and these people back here are those who are close to the company or who have expertise or what have you in an industry that gives them an advantage. So obviously we want to be part of this group. We don't want to be part of this group. If you read the newspapers or follow the media, typically the media is late. They only get interested in the stock when it's already done well. You start hearing about, cannabis stocks and what a great run they've had after they've already moved up 300%. Most of us aren't hearing about companies in the mainstream media when the trends are just starting, because that's the way it works. Mainstream media reacts to news, but the market speculates on what the news will be. So the people that are buying back in here are speculating that there will be news ahead, and the people up here are reacting to the news when it's already come out. Now, it's important to recognize that no matter how good your approach, no matter how smart you are or you think you are, you will not be right all of the time. I am wrong every day. I'm a professional trader. I sit in front of my screen all day, buy and sell stocks. I've done it for nearly 30 years. Actually, I've done it for about 30 years, almost 30 years. And I'm still wrong every day. I don't think I've had a day that I can recall. I probably have, but it's very rare that I have every trade that I buy work. There's always going to be some losers. And because of that, we need to have a plan for what we will do when we are wrong, because trading is really a probability game. And since we're not going to be right all the time, we have to have a plan for what we are going to do when we are wrong. So this is a stock that, I don't know if I bought it or if I featured in one of my newsletters, but right here, met all my criteria, had the volume, had the price action, the stock scores indicators were in the right place. Pretty good pattern. This is called a bottom fishing pattern. And it failed. And when it went through this floor price right here, got out, see you later. Sad, but not broken, because the size of the loss was not that big. And it was certainly better than holding that stock through the downdraft. The stock today is even lower. And it's tied up money. If you didn't get out when the market told you to get out, you'd have tied up that capital for another 5 months at a loss instead of putting it to work in a place where there was better potential. And so selling losers when the market tells you that you are wrong is important because it allows you to minimize the size of the loss, but it also releases that capital so that you can put it to work somewhere else. And it's not just your financial capital, it's also your feelings. Holding on to a loser for a long period of time is emotionally draining. It'll put you in a bad mood. And why do we want to be in a bad mood? We don't want to be in a bad mood. Let's just get rid of our losers early and move on to the winners. And so this is the last point that's critical in how I approach the market, and that is when we are right, we should let the stock work. I never, ever, ever set a price target for a trade that I have made. I never buy a stock at $10 and say when it gets to 15, I will sell it. Because if a trade is working, I'm going to stick with it for as long as it is working. What that means is that I will never get out at the tops. I will wait for it to weaken a little bit before I get out. But it also means I'll enjoy most of the trend because I'm willing to stick with the trend as long as it is working. And so if we look at one of the top performing large cap stocks of the last decade, Amazon, this is a 3-year chart of Amazon. And let's look at the more recent run in Amazon from about a year ago. It stayed in an upward trend. We call this an upward sloping channel. And it stayed in that channel until 4 weeks ago when it broke down. And in that time, it has gone up, 80% in a year. This, a stock that is, or it was, in the $1,200 range. And in the course of a year has gone to $2,000 and then just broke down at about $1,800 a share. This is a weekly chart. That's a good gain for the time held. 50% from entry to exit. But along the way, there were some hiccups, little minor bumps where the stock was maybe down for the week. But those bumps did not break the trend. We'll talk about trend breaks in a little bit. So we're sticking with the winner as long as it's working. Now, there have been other periods when the stock was in a winning trend. We have back here and then there, a little bit of a trend after this breakout right there. So I want to be in stocks when they're beating the market, and when they're not beating the market, move on, put the money somewhere else. So how do I find the stocks I want to trade? What do I focus on? Well, I've created an indicator called an action candle. An action candle has a volume and price criteria which uses statistical analysis to look for statistical significance in price and volume activity. It's a fairly long formula. It's not one that I share. It's built into the Stockscores website. It's built into the indicators I use to day and swing trade and position trade the market, which is, very short-term, medium-term, and long-term trading. And just about every trade that I do revolves around the action candle. But it's not only the action candle, because if I just bought every stock that made an action candle, I would not make any money. We have to qualify which action candles are worth considering using basic chart analysis, things that you can Google tonight, predictive chart patterns, that sort of thing. There's lots of books that have been written on predictive patterns. I'm not changing the world with my reference of them. I think that a lot of people explain them in a confusing way. They shouldn't be confusing. They're relatively simple. And if you can understand 6 aspects of predictive chart patterns, you can see any chart pattern. It just takes some practice. Risk management is paramount. Our number one goal, as I always say, is capital preservation. We have to protect our capital. And we do that by planning to lose. We never plan to win. We buy a stock. We know where the exit door is, the point where we're going to get out because the market has proven us wrong and take a small loss. We don't want to let small losses grow into big losses, but we also need to give stocks a little wiggle room. It's not okay to, sell at the first sign of weakness. Often stocks will pull back for, a month after I get an entry signal on them before they finally start to move. So we have to have some patience, but not too much patience. And going into every trade, I know where I'm going to lose my patience. At what price level will I get out and move on? And we can't pick that number arbitrarily. We should never say, oh, when the stock goes down 10%, I'm going to get out. That makes no sense, because some stocks, a 10% move is substantial, and for others, a 10% move is potentially happening in a day. And so we have to use some simple methods to identify the true point where the market will prove us wrong. And when I teach people my method, I show them how to do that, and it's really based on sound theory about fundamentals and what the chart of a stock represents in terms of fundamentals. Stocks don't go up because they have a technical analysis indicator showing a certain value. Stocks go up because the perception of fundamentals are improving. And what we see in a stock chart is only a representation of the market's opinion about the fundamentals. Now, when we get a winner, we got to be patient with them. We talked about that already. Let the winners run. And we shouldn't try to be perfect. We should not try to get in at the low or out at the high. What we're trying to do is capture the bulk of a major move in a stock where the stock is beating the market. And if there comes a time when it stops beating the market, then we'll get out and not be afraid to get back into that stock even 6-8 months later if it gives us a new entry signal. And that's the sort of thing that happened on Amazon, where it outperformed the market for a while, and then it really didn't for a number of months. And then it started to outperform again. So my sense is to always be moving to where the trend is strong. So if we sort of wrap all these things up into this chart again, we have some abnormal activity here, which tells us that something is going on. The people that know the most are buying. There is a predictive chart pattern here. It's called an ascending triangle. And when you enter that stock, you plan to lose if it's going to fall down below support. And as the stock marched higher, we stick with the trend because the trend is working until it stops working, and then we get out. And if this stock 3 months from now has a new pattern break with an action candle, I'd be happy to buy it again. But for now, I would stay out of that stock because the market beating trend has been broken. So how long does it take to do this? How long does it take to find the winning stocks, potential winning stocks of the future? Well, it depends on the time frame that you want to do it. If you have 15 minutes a day, then I have strategies for you to focus on. I've listed them there. They are strategies that I teach in my investor course, something called the action breaks, which is the one I'm doing most often right now. Actually a fairly new strategy, something I started using maybe 2 years ago. Stockscores Simple, something I've been using for probably 20 years. Bottom fishing, probably 15 years. Abnormal breaks, probably 15 years. But the concepts are all the same. We're looking for evidence in the market that the buyers are strong, that they are motivated to buy because they have some good information. And it's also important that the sellers are not motivated to sell. That also helps stocks go higher. You can have a lot of motivated buyers, but if you have some sellers who are equally motivated to sell, the stock's not going anywhere. Now, if you don't want to do your analysis on a daily basis, perhaps you want to have a life and not sit in front of your screen every day for 15 minutes, then choose a strategy that requires 15 minutes a week of work. And the two that I like to use are the Stockscores Simple Weekly and the Stockscores ETF Weekly. This is longer term time horizon. In the case of the work that you do 15 minutes a week, you're looking for stocks that you might hold for months. even years. The work that we do 15 minutes a day, our time frame is probably more like 2 or 3 months. So the shorter the time frame, the more often you have to do the analysis, and the shorter the expected hold period. Now, what do you need to achieve success in managing your own money? Well, you need some knowledge. You need to know what to look for. You can get that from me if you like. I've created online education material to teach people my approach, or you can do it as I did, figure it out for yourself. It takes a lot longer and costs a lot more to figure it out for yourself, but some people prefer to take that path. My aim in teaching people is to speed up your process and help you avoid expensive mistakes. You also need a tool to find what to look for. That's the market scan tool that I've created on Stockscores, is the one that I use. So let me show you those two things quickly. We're going to jump over to the Stockscores website, and the education is under Trader Training. If you're a member of Stockscores, you've taken the Investor or the Active Trader course, you can go into the Education Center. And in the Education Center, you can watch videos, read lessons, do assignments, do tests. If I wanted to learn about risk management, I could read the lesson. If I wanted to watch the video that I did, I could watch the video. If I wanted to do the assignment to make sure I understood the concepts of that lesson, I could do that there. And finally, if I wanted to test my knowledge, there is a quiz for me to do to make sure I understand the concepts. So it's all in-depth education online. You can do it from your computer, your phone. You can do it anywhere that you have an internet connection. It used to be that if you wanted to learn my approach, you had to sit in a classroom for a weekend, and I taught it over the course of 2 days typically. And now it's all online, which allows me to teach people anywhere in the world. And I think more importantly, it allows the student to review the lesson as many times as they like. Because when I taught in a classroom, you had to remember what I taught you, and we gave you books and that sort of thing, but there was no reference to go back to on a repeated basis. So now, if you don't remember what the 6 elements of chart patterns are, you can go in and read all about it, watch the video. And maybe 6 months from now, you forgot how to scale into a position. Well, go back and review the lesson that you may have reviewed 3 times already, but why not review it one more time? There's no limit to how often you look at this. If you purchase one of my courses, there is no limit to how long this material is at your disposal. I suppose in theory one day it might disappear, but I've been doing this for 20 years, and the people who took my first course 20 years ago are still have access to this material. All right, now the market scan is a really great tool, a great time saver. My motivation for building it when I built it back in 1999, 2000, it's been modified along the way, but essentially the same concept, was to save time, to help me find good stocks early in their trend. And so I can select a market scan and I can run it, and it goes through every stock that trades. In this case, I did a scan on the US market. I went through every stock that trades on the US market. There's probably 7,000 or 8,000, and it found 103 that meet the criteria of that strategy. And then I can just cycle through them and look for the right chart pattern for that particular strategy. And if I like what I see, Fitbit's not bad, but not really worth the risk. I'd give it a 6 out of 10. But it has the pattern that I want to see for that particular strategy. So when I say 15 minutes a day, it's because of this tool that you don't have to spend a lot of time. Here's one that looks pretty good, SOGO. I'd give this a 7 out of 10. Breaking a downward trend line, abnormal price and volume activity today. Looks like a stock that's on the start of a recovery. All right, so how long did that take? Not long at all. I could continue to go through the pages of charts. There's 100 tonight because the market was up pretty well after the recent correction. We're getting a little bit of a snapback in stocks. And so normally there isn't 100, maybe on a normal day, 20 or 30 charts to look through. And it really, once you practice, you really can do it this quickly. Like there's just certain things that I teach you that with practice you'll know to look for. Pitney Bowes is another one. Give that a 7 out of 10 as well, if I was to rate it. Okay, so that's the basic process, a quick look at the tool, a quick look at the Education Center. If you want a more in-depth look of those things, on Saturday I'm going to do another webinar, and we will spend a little more time looking at those things. I think it's important while you're learning to have support from someone who has made every mistake known, and that's me. I have traded a long time and I've made lots of mistakes over and over again. And, you know, I always say that if you send me an email showing me a few of your trades and mistakes that have made, maybe you've had some losses, I can usually tell what the cause is, what's wrong with you psychologically. And it's actually not that anything's wrong with you. It's that you're a normal human being, and normal humans are predisposed to fail in the stock market because we are emotional. And you show me some of your trades that haven't worked. Maybe you did everything right. That's sometimes the case, but usually there is a bigger problem. And if you ask me, as one of my students, I can give you some insight into what's causing problems. That's something I do for all of my students, whether they took my course 15 years ago or took my course yesterday. It's something that's available. And then, of course, if you're going to invest in the market, you need capital, discipline, and work. And that's the things that you have to bring. I always, recommend that people start with a small amount of capital, even $0 of capital, just to learn and practice. But obviously, if you're looking to manage your retirement portfolio, that's your capital. And then it comes down to the discipline to follow rules and putting in the work to not only learn the material, but if you want to find stocks, you got to do that 15 minutes a day or that 15 minutes a week, depending on the strategy you're going to apply to identify things. You don't have to do it every week. If you're on a trip and you don't feel like looking at the market, that's fine. You don't have to. But it takes some time to make money. It's not any different than anything else. So the Stockscores Education Center, which I just showed, has a few different functional areas. There's the foundation area, which has the theory that you need to understand in order to apply my strategies. And as I showed you in that area, there are written lessons, videos, assignments, and tests. Then we have the actual strategies, which are the rules for when to buy, when to sell, and the process for identifying opportunities. And those are in the investor and active trader areas. Tonight's focus is on the investor section, which is the longer term trading style. The webinar that I did on Tuesday was on active trading, and you can review the video of that if you missed it. It's on the Stockscores YouTube channel. The investor course, which is our focus this evening, gives you access to the foundation lessons in the Stockscores Education Center. You will learn my strategies and have access to those preset market scans on the Stockscores website, email support from me, and use of my tools on Stockscores for 6 months, included with the cost of the course. And you can renew that access for $300 per year. We do have something called the Mentorship Program, which is really targeted at more active trading. So if you have an interest in day trading, swing trading, there is a mentorship program that starts on November 20th. There will be 12 weekly online meetings. There is 3 months of my daily email with lessons and examples of trades. There is a one-on-one online meeting with me. So lots of things to walk you through the strategies, the processes, the lessons of the material on a more in-depth basis. I think it's especially helpful for those who just need someone to give them a kick every week to learn the material. If you're maybe not a really good, motivated self-starter, maybe you're like everyone else and you procrastinate a little bit, the mentorship's going to help you with that, because every week we do a lesson and I'm going to teach it to you. That mentorship program is limited to 15 students, and there are currently 3 spots left. So if you have an interest in that, it's filling up fast. So in addition to the online material, I am going to do some complimentary live trading for anyone who purchases the course in the next, anytime leading up to the course here, up until November 8th. You will get attendance at the Saturday, November 10th overview class, which will be about 3 hours, 2.5 to 3 hours, much like today, but certainly a lot more in depth. A webinar like you have today, but you can ask me questions. We can go through examples. And again, I walk you through mostly the theory, a little bit of the strategies. And then a couple weeks later, we start practicing what you've learned, where I will do market scans in front of you 3 days, and we'll try to pick some stocks. So you can just see me actually applying the strategies, not just talking about them. And for those who do the Active Trader course or the Mentorship course, we also have a service called Active Live where you can watch my trading screen. I should say my analysis screen, the screen that I use to get my entry signals for my day trades and swing trades. And you're basically watching my screen all day. You don't have to watch it all day. Most of the work we do is in the morning, but you get 1 month of that service for free if you purchase in the next little while here. So the special offer for anyone who purchases my courses up until November 8th at 11 p.m. Pacific time is the overview class and the applicable strategy application series for free. If you take the investor course, you get the investor application series. If you take the active trader course or the mentorship, you get both the investor and the active trader strategy sessions. And of course, the Saturday overview class. Here's the pricing. $2,495 Canadian for the investor course. Active trader course is $3,495. Mentorship, $5,495. I get a lot of questions from my past students who maybe have taken the investor course in the past and they wonder how do they upgrade to the active trader course. I'm just going to show you that. So if you want to do that, let's say you took the investor course 2 years ago and you want to upgrade to the active trader course, go into the education center and just slide down. You see here how it says for me purchased. If you don't have the active trader course, it won't say purchased. And if you open it, it will have a link here to upgrade. So the upgrade from investor to active trader is $1,250. And if you've taken the active trader already and you want to upgrade to the mentorship, then you pay the $2,000 price difference. But for that, you have to email me. And if you want to take the active trader course, or pardon me, the mentorship course, you have to email me. All right, I'm just going to start a poll here. I do this every meeting, so I have a sense of who would like a follow-up email. I won't send you a follow-up email on courses if you're not interested. So I'm just going to launch this. It'll take a second to come up on your screen. And if you don't mind answering the appropriate way there, then I will have an email list that I can send some follow-up information, which will probably come to you on maybe Saturday afternoon. And if you don't want email from me, then just say no, I won't send anything to you. And then after that, we're going to talk a little bit about when to get out of a trade or a market. We've obviously had a crazy October. Some of you may have seen the picture I sent out depicting how people felt at the start of October versus the end. That was a couple pictures of my daughter, who is really good at doing stage makeup, and we were helping out some friends who run a big haunted house in the city where I live, and she was the chief scare person in the haunted house with that crazy makeup. So if you didn't see it and you want to see it, go look on my Twitter feed. I posted the picture on Twitter as well. All right, so we'll close the poll down in 10 seconds here, and then we'll get on with a little bit about when to sell stocks using pattern recognition. Okay, so I'm going to close this down. Thank you for answering. And again, that follow-up email will probably come Saturday after my webinar Saturday morning. All right, so when to get out. So if we want to really simplify this, and we can get a little more sophisticated in our exits, I get more sophisticated with the course material, but just to give you a simple place to start, we want to exit winners, or markets that have been trending for some time, when the relevant trend line is broken. And now what is the relevant trend line depends on the time frame that you are trading. If you're day trading, the relevant trend line is very different than if you are investing your RRSP or your TFSA or your 401k or whatever your retirement plan is. That's obviously a different time horizon than the day trader would have. And so, very simple. You need a pencil and a ruler, and you need a chart. And with that, you can define trend lines. And so this is a chart of the S&P 500, and I can draw a trend line on the daily time frame and see that that daily time frame was broken there, which was a signal that there was problems ahead. Simple break of the trend line. We could do it here too. This trend line was parabolic, and we had a break of the parabolic trend line there a few days before the really sharp sell-off that occurred in February. Kept you out of the market while the market went through a kind of a rough patch there through February, March, and April. By the same token, when the downward trend line for the market was broken, right there, that started the upward trend. So trends are super powerful. I spend a fair bit of time teaching them, and I use them every day in my own trading. We can get shorter term in our definition of trend. I could take this trend right here and define it by that trend line I just drew, and that got us out a little bit earlier. The market failed to hold that trend line and then broke down. So just simple, take a ruler and let it hit what we call inflection points. So I call any of these peaks or valleys here inflection points and just draw a line through them. Here, some peaks, draw a line, and that doesn't have to be perfect. Draw the line that best fits the peaks and valleys, and you've defined the trend, and look for trend breaks, either as entry or exit signals. Here's a very long-term chart of the S&P 500. We have two trend lines on here. We have this one, which goes back a number of years. This is a monthly chart. And then we have the shorter term one. I didn't draw that great. Let me try again. It's a little bit hard. I'm using my finger here. And you can see that we've held the monthly trend line. And if you watched my couple of videos I did last week on YouTube, where I talked about the correction and whether it was something to really worry about, with just 3 days left in the month, I said, well, as of right now, the monthly trend has been broken. But we had a little comeback in the last few days, and the market ended up holding that monthly trend line. And so therefore, it's not as dire as it was just a week ago when we were actually below that trend line. I'm not certain that we'll hold this, but for now we have. And so if you are that longer term investor with long-term money in the market, well, the long-term picture is still okay, but we are at a critical point. We need to hold that monthly trend line. You can use it on individual stocks as well. I showed you this earlier, but just take the same concept. Start with inflection points, draw a line across them. There's your trend line. And there was the break of the trend line 4 weeks ago. Stock was at $1,800. It went down to $1,500. 3 weeks, starting to bounce back a little bit now. But I think Amazon probably is destined to go sideways for a while in that range and could even fall lower. I don't see it likely to make new highs anytime soon. And if I had owned Amazon, I didn't, but if I had, I would want to be out of it now. And I think there's better places to put the capital. Now, if I'm a short-term trader, I look at this a little differently. As a short-term trader, I'm seeing that the stock was very oversold and therefore due for a bounce. And we started to get that bounce already starting 2 days ago. So if I'm a swing trader, maybe I do want to own Amazon, but it's a different question then. As a long-term investor, I would not want to be in Amazon. As a short-term trader, we can actually jump over to the Stockscores website here, and I'll just show you the shorter-term chart. I have to go to the right page here. Hold on a second. Let's bring up Amazon. And we're going to make this an intraday chart, 60-minute. And Amazon got what's called parabolic to the downside. So here is the downward trend. We haven't broken that yet, but we did get quite parabolic. And one of the things that I teach often is that stocks or markets that fall away from their trend line usually come back to them. Here we fell away from the trend line, so this little action there was a cue that maybe we were going to come back up to the trend line. We've done that. We haven't broken the trend line yet. I actually think that Amazon will get stuck here in the next few days and take some time to break that downward trend line. That's simple stuff, and that's the kind of thing that I can teach you. I've really just touched on it, but those are the kind of things that I can teach you if you have an interest in learning from me. So if you'd like to register for the course, you can go to stockscores.com/learn. I'll just show you that. Go to Trader Training, learn how to trade. And there's some videos on here. There's more information on what each course has in it. As I said, some videos, so you can read up on those. And you can purchase it right there. Just go order Active Trader and you can buy the course online. Once you've purchased it, you have instant access to all of the material online, and you'll get a follow-up email or two from me about the upcoming classes in November. If you have questions for me, there's my email address, tylerb@stockscores.com. If you would like to follow me on Twitter, just do a search for Stockscores. If you want to see the change in my daughter's appearance from early in the month to late in the month, it's kind of funny. You can take a look at that on Twitter as well. And if you want to follow me on YouTube, I put up at least one video every week, sometimes more. And I think they're insightful and they're free. So why not get some free education from the YouTube channel, stockscores.com. All right, well, that is my presentation, but I do have some questions to answer, so I'm going to take a look at those now. And I got to find my mouse here so I can read these. Question number 1, is the written lesson different from the video lesson, or should you read and watch them both? I mean, they're complementary. In one, I'm explaining what I've written about. I think it comes down to your learning style. Some people like to have things taught to them. Other people like to read things. I think you should do both. But they're both there depending on your learning style, what you like. Second question, how long is the November 10th meeting? It'll go from 9 till 12 a.m. Pacific time. I could finish a little bit earlier sometimes, but depends on the questions. I plan for 3 hours. It might take 2.5. So another question, which is a bit long, so I got to read it here. On the topic of when to get out, do we hold an open position longer than the intended time frame if we don't get an exit signal, i.e. day trade? If no exit signal by the end of the day, do we still exit or wait until the next exit signal? So with day trades, I sell them at the end of the day, and that's mostly for risk management reasons. Now, if a day trade also meets the requirements of a swing trade in terms of the rules, then you may want to hold it longer. But typically in that scenario, you're probably going to have to scale back your position size, because when you hold stocks overnight, there is a higher level of risk because there's the potential for a price gap. So you can hold a day trade as a swing trade and hold it for days, but you have to adjust your risk tolerance or your risk size. Next question, are your tools real-time or delayed? I have both. The Stockscores market scan is delayed. It's intended for position trading, investing, and so real-time isn't really necessary. For day trading, we have other tools that we use in TradeStation or my active live webinar where you're watching my analysis screen, and that is real-time. Next question, will the November 10th session be replayed? It is recorded, and all of the students who paid for that information will get a link to the video. That link is not for anyone to watch. It's only available for my students to watch, and you will get an exclusive link to that, which you can watch the video forever if you want. Well, I hate to say forever because forever is a long time, but like I said, if you took my course 8 years ago, those videos are still available. Next question. I'm interested in investor course and active trader course. Which do you recommend one take first? So from a difficulty standpoint, there's no difference. Like, don't feel like you need to do the investor material before you can understand the active trader material. It's not really like that. The foundation is the theory. The only difference between investor and active trader is just, it's different strategies, different rules. And so you really should do the one that you feel you will want to apply. If your interest is remotely in active trading, maybe you want to start with investing first, but ultimately you'd like to active trade, then I recommend you do the active trader course, because you'll save yourself a little bit of money on the upgrade. When you do an upgrade from investor to active trader, you pay the price difference plus $250. So you're saving yourself $250 if you do the the active trader right from the get-go. But if you're sort of casually interested in active trading, but it's not something you think you're going to do for a few years, then I don't think the $250 is a big deal. I would wait. Okay, next one. Would you use a Wi-Fi connection to position swing and or day trade? Yeah, I think so. I often do. I mean, when I'm day trading, I do have a wired connection. It is more reliable. However, I travel a lot and I'll trade from my hotel room on pretty slow Wi-Fi with my laptop. I'm okay with that. The Wi-Fi connections nowadays are a lot better, but I think you have to have a reliable Wi-Fi connection, not one that's flaky and where you have bad coverage, that sort of thing. So I can remember, in the early days of the internet, when the internet went down a lot, Wi-Fi connections weren't reliable. I used to have a backup connection, but now it's pretty reliable. The only issue I've had in the last year was a power outage, where because the power went out, I think somebody hit a pole near my house. We had no power, so although I have battery backups for my computers and such, I didn't have an internet connection. So I had to use my cell phone and my laptop. My laptop runs on a battery and my cell phone didn't require power. So that worked, but that wasn't a great situation. I have a couple of laptops. Okay for trading, or would I need a PC? It depends on the style of trading you're going to do. If you're going to run TradeStation, I think it's nice. You don't need a like a laptop's okay, but if you're going to run TradeStation, I recommend you use a PC. You can use an Apple computer as well, but you have to run Parallels or Boot Camp so that you can run Windows. Those are getting a little bit more in-depth in the weeds questions. If you want a little more feedback on that, just tell me your situation in an email, and I'll try to give you a little more guidance. Next question, is the stop loss limit your plan B for outages or network problems during day trading? Partly, yeah. You never know what can happen if the market really moves quickly and I'm not in front of the screen, or if I'm, if I have some technical problem that prevents me from exiting when I should. But mostly stops are emotional management. They're for us to, keep our heart out of the trading decision. Stops get executed automatically. I only use stops when I'm day trading. I do not use a hard stop loss when I am position trading, because we have a different concept for that, where we look for the stock to close below our exit price. Next question, do you need to have a subscription to TradeStation, or do you get that through Stockscores? So TradeStation has nothing to do with Stockscores. I use it as a tool, but if you want to use TradeStation, then you have to subscribe to it. You don't need it as much as you used to, because I now have this active live service where I'm doing the analysis for you. Some people want to be independent and they want to have their own TradeStation account, and that's great. I'll give you a lot of the indicators that I use to identify opportunities, but like I said, you don't need it as much as you used to. And I've heard, somebody told me just the other day that TradeStation has actually lowered the price on the subscription. It used to be $249 US, and it didn't include radar screen, which was another $59. And then it was $249 and it included radar screen. And by the way, my students were getting a $100 discount on that, so it was $149. And I've heard now that they've lowered it again to $99. So it's getting to be even more competitive to use TradeStation. But I don't know if that's a long time deal or like a limited time offer deal. I'm not sure. One of my students just signed up for TradeStation. That's what they were telling me that they got. Next question. If you were to buy a new laptop, would you still recommend a Surface which I believe you discussed a few years ago. So I like the Surface a lot. I'll tell you the one thing I don't like about it is that the aspect ratio of the screen is not a 16:9 aspect ratio. And for me, that is an issue because I do a lot of videos, and when I upload a video to YouTube, it's in the resolution of either a 4K resolution or an HD resolution, which is 16:9. Now, again, this is getting a little technical, but I had a hard time doing my videos on a Surface because the aspect ratio of their screens is odd. And so that was my main complaint about the Surface. Other than that, I think they're great, and I think they just won the award for Laptop of the Year or something. I don't know. I think they're good tools. I did have a little bit of problem with my screen, but I had like a first generation Microsoft Surface computer, so they may have got that out or fixed along the way. I mean, I loved it. It was great. I now have a Dell laptop primarily for the aspect ratio. It has a beautiful screen, 4K screen, and it has a normal aspect ratio screen, but it wasn't cheap. It was quite an expensive laptop, and I don't think most people need that. I have it with, I think it's called an XPS 15, but I have the absolute loaded one, which had the best processor and all SSD memory and that kind of thing. I just did a video on trading computers, which you can watch on my YouTube channel if you want to learn more about that as well. There's lots of videos on my YouTube channel to take a look at. All right, well, I don't see any more questions rolling in. Oh, here's a new one. Is there a Canadian versus US version of TradeStation? Unfortunately, TradeStation only covers, well, they don't cover Canadian markets. They cover US markets. They cover, I think, European and Asian markets, but they do not cover Canadian markets. So I can't do my analysis of Canadian markets with TradeStation. And it's not a big deal because day trading the Canadian market isn't so easy. There isn't as much liquidity on the Canadian market. So that my desire for real-time, fast-moving trading on the Canadian market is less. I prefer to do that on the US anyway. And, you know, if you're a Canadian, I'm a Canadian. If you're a Canadian and don't feel like you have to shy away from the US market, it makes no difference in terms of trading. You don't even have to endure the currency exchange in and out. If you're short-term trading the US market, with some brokers, they will give you buying power based on the Canadian dollars you have. And again, these are questions that maybe I'll go into more on the Saturday seminar, webinar, or you can email me if you have specific questions. So, all right, so I don't see any more questions coming in. I am going to end tonight's webinar. Hopefully it was informative, and hopefully we'll see many of you on Saturday at that webinar. I'll give you a little bit more of an in-depth tour of the Stockscores website and the different education tools we have, answer some of the common questions I get. Otherwise, hope you've enjoyed tonight's webinar, and we'll talk to you again soon. Have a good night.